If you are 60, 61, 62, or 63 years old right now, there is a 4-year window open for you that has never existed before in the history of the American retirement system. And the IRS is essentially handing you an $11,250 bonus to save for retirement every single year that you're in it. Most people in this age group have absolutely no idea this window exists, and that is one of the most expensive pieces of missing information in retirement planning today. Because if you are in this specific age range and you have access to a 401k, a 403b, a governmental 457 plan, or the federal thrift savings plan, you can now contribute more to your retirement account than any other age group in America, including people who are older than you. That's right. You, at age 60 to 63, can put more into your retirement account this year than someone who is 65, 67, or even 70. This is not a loophole, it's not a mistake, it's not too good to be true. It is a deliberate provision of federal law, created specifically to help people in the final stretch before retirement make up for lost time. Today I'm going to explain exactly how this works, exactly how much you can contribute, why Congress created this provision, who qualifies, and most importantly, what you should do right now to take full advantage before this window closes. Let's start at the beginning, because to understand why this provision exists, you need to understand the normal catch-up contribution rules first. The standard 401k contribution limit for 2026 is $23,500. That's the maximum any employee can contribute from their paycheck to their 401k account. But once you turn 50, the IRS gives you something called a catch-up contribution, an additional amount you're allowed to contribute on top of the standard limit. For most people 50 and older, that catch-up contribution is $7,500 per year, making the total contribution limit $31,000 for the year. That's already a significant advantage over younger savers, $31,000 versus $23,500, and it exists specifically because the IRS recognizes that many people didn't save enough earlier in their career and need to accelerate. But then Secure Act 2.0 came along, and for people ages 60 through 63 specifically, it created something entirely new. Starting in 2026, people who are 60, 61, 62, or 63 years old can make a super catch-up contribution, an enhanced catch-up limit that is significantly higher than the regular 50-plus catch-up. The super catch-up contribution for 2026 is $11,250. Not in addition to the regular catch-up, this is the catch-up amount for this specific age group. So let's put the full numbers together. $23,500 standard limit plus $11,250 super catch-up equals $34,750 total. $34,750 that you can put into your retirement account in a single year. And that's just a 401k. We haven't even talked about IRAs yet. Compare this to someone who is 64. They can only contribute $31,000 because they've aged out of the 60 to 63 window, $3,750 less per year. Compare this to someone who is 58. They also can only contribute $31,000 because they haven't yet entered the 60 to 63 window. Only ages 60, 61, 62, and 63 get the super catch-up. It is a 4-year window that opens at your 60th birthday and closes the day you turn 64. And if you are in that window right now and you are not taking full advantage of it, you are leaving one of the most valuable retirement savings opportunities of your entire life completely untouched. Now let me show you why the dollar amounts here are genuinely life-changing. Because the numbers compound in ways that most people don't fully appreciate. Let's say you're 60 years old today and you maximize the super catch-up contribution for all 4 years, from age 60 through 63. At $34,750 per year for 4 years, you're contributing an additional $15,000 per year compared to what you'd contribute at the regular 50-plus limit. That's $15,000 extra per year times 4 years, $60,000 in additional retirement savings over the 4-year window, compared to what you would have contributed without the super catch-up. And if that money grows at a 7% average annual return, a conservative assumption for a diversified retirement portfolio, by the time you reach 67, those additional contributions could grow to roughly $72,000 or more. $72,000 of additional retirement savings simply from taking advantage of a law that most people don't even know exists. Now let's look at what $72,000 means in retirement income. At a 4% withdrawal rate, $72,000 generates $2,880 of additional income per year for the rest of your retirement. $2,880 per year, that's $240 every single month, permanently, just from maximizing a 4-year contribution window that opened on your 60th birthday. That's grocery money, that's utility bills, that's an emergency cushion, and it exists entirely because you knew about this provision and acted on it. Now this applies to 401k plans, 403b plans which are common for teachers, healthcare workers, and nonprofit employees, governmental 457 plans for many state and local government workers, and the federal thrift savings plan for federal employees. If you work for an employer that offers any of these plans and you are between 60 and 63, this provision applies to you. Talk to your HR department or plan administrator to confirm and to update your contribution elections. Now what about IRAs? Because not everyone has access to an employer plan, and some people have both. For traditional and Roth IRAs in 2026, the contribution limit for people 50 and older is $8,000, $7,000 regular plus a $1,000 catch-up. The Super Catch-up provision does not apply to IRAs. It is specific to employer-sponsored plans, so the IRA limit stays at $8,000 regardless of whether you're 60, 63, or any other age. But here's how to maximize everything simultaneously. If you have access to an employer plan and an IRA, you can contribute $34,750 to your employer plan and up to $8,000 to your IRA in the same year. That's a combined retirement contribution of potentially $42,750 in a single year for someone ages 60 to 63 with access to both types of accounts. $42,750 saved in a single year, tax-advantaged, compounding, and building toward the retirement security you've worked your whole life for. Now I know what some of you are thinking. Bob, this sounds great, but I'm already stretched thin. I can't afford to max out $34,000 a year. And I hear you. That's a very real concern, and I want to address it honestly. You do not have to max out the full $34,750 to benefit from this provision. Every additional dollar you contribute above what you were previously contributing matters. If you can increase your 401k contribution by even $500 per month, $6,000 per year, that is $6,000 more building towards your retirement that wasn't there before. The goal is to contribute as much as you can reasonably afford within this 4-year window, because the window will close on your 64th birthday, and this specific opportunity will never be available to you again. So look at your current 401k contribution percentage and ask yourself, can I increase this by 1%, 2%, 3%? And if you can, do it now, not next month, not next year. Now let me talk about why this provision was created, because understanding the why helps you understand the urgency. Congress created the Super Catch-up through Secure Act 2.0 because the data showed that millions of Americans in their early 60s were significantly behind on retirement savings after spending their 40s and 50s managing mortgages, college costs, and family expenses. By the time the kids are through school, the mortgage is manageable, and the highest earning years of the career have arrived, people in their early 60s often have the greatest capacity to save, but the standard limits don't reflect that capacity. The Super Catch-up was designed to match the contribution opportunity with the life stage where it is most realistically achievable: peak earnings, reduced family obligations, and a clear retirement timeline. If you are in your early 60s and your income is the highest it's ever been, your kids are independent, and your mortgage is nearly paid, this provision was literally written for you. Now I want to connect this to something we discussed in our previous video, the retirement savings gap. We talked about how the new retirement savings target for 2026 is $823,800, and how the median American 65 to 74 has only $200,000 saved. That's a $600,000 gap for the median American, and for many people in their early 60s, closing that gap feels impossible. But here's what the Super Catch-up provision does to that math. If you're 60 years old with $200,000 saved and you maximize the Super Catch-up for 4 years at $34,750 per year, you're adding nearly $140,000 of direct contributions by age 64. Add 7% average growth on all of it over that 4-year period, and your balance could realistically grow from $200,000 to nearly $400,000 by 64. And that's before Social Security, before any other savings, before any other strategies we've discussed. The Super Catch-Up alone can move the needle more than any other single action available to someone in their early 60s. It's the most powerful legal tool in the retirement savings arsenal for this specific age group. Now let me talk about the tax benefits. Because these contributions aren't just growing your savings, they're also reducing your tax bill right now. If you contribute to a traditional 401k, your contributions come out of your paycheck pre-tax, meaning you don't pay income tax on that money in the year you contribute it. For someone in the 22% federal tax bracket, contributing an extra $11,250 in Super Catch-Up contributions saves them $2,475 in federal taxes this year alone. For someone in the 24% bracket, that same contribution saves $2,700 in taxes, real money that stays in your pocket instead of going to the government. And for state income tax states, add your state rate on top of that. The combined federal and state tax savings from maximizing your Super Catch-Up contribution can be $3,000 to $4,000 per year or more. So the Super Catch-Up does two powerful things simultaneously. It builds your retirement savings for the future, and it reduces your tax bill right now. Now let's talk about the Roth option, because if your employer plan offers Roth 401k contributions, the Super Catch-Up applies there too. With a Roth 401k, you contribute after-tax dollars, meaning you pay income tax now, but everything in the account grows tax-free and comes out tax-free in retirement. Whether a traditional or Roth approach is better for you depends on whether you expect to be in a higher or lower tax bracket in retirement. But the Super Catch-Up limit of $34,750 applies to the total of both traditional and Roth contributions combined. You can split the $34,750 however you want between traditional and Roth, and the combined total cannot exceed the limit. This flexibility allows you to optimize your tax situation both now and in retirement, contributing some to traditional to reduce taxes today and some to Roth to build tax-free wealth for tomorrow. Now I want to address something critically important. What happens if you can't fully maximize the Super Catch-Up because you're already living on a tight budget? The answer is to look for every possible source of extra funds to redirect toward this opportunity, because the 4-year window will not wait. Are there expenses you could reduce temporarily, subscriptions, dining out, discretionary spending, that could free up even a few $100s per month to increase your retirement contributions? Could you take on a side income for 1 or 2 years, part-time work, consulting, selling unused assets, specifically to fund your Super Catch-Up contributions? Could you redirect a bonus, a tax refund, or an inheritance directly into your retirement account rather than spending it? Every source of additional funding deserves to be considered through the lens of this 4-year window, because the opportunity to contribute at this level disappears on your 64th birthday and never comes back. Now let me talk about a very important practical step, because knowing about this provision and actually taking advantage of it requires action on your part. Your 401k plan does not automatically increase your contributions when you enter the 60 to 63 window. You have to actively update your contribution election. Log into your employer's retirement plan portal, find your contribution settings, and increase your contribution rate to take advantage of the higher limit. If you're not sure how to do this, or whether your plan supports the Super Catch-Up, call your HR department or your plan administrator directly. They can walk you through the process and confirm your eligibility. Do this today, not this week, not next month. Today, because every paycheck that goes by without maximizing this contribution is a missed opportunity you cannot recover. Now let me address one more angle that I think is really important for people in this age range: the intersection of Super Catch-Up contributions and long-term care planning. We covered in our last video how the traditional long-term care insurance market has largely collapsed. Premiums have increased 50 to 100% on existing policyholders as insurers massively miscalculated longevity and care costs. And we covered the new 2026 tax rule that allows penalty-free withdrawals of up to $2,600 from retirement accounts to pay long-term care insurance premiums. Here's how these two things connect. By aggressively using the Super Catch-Up to build your retirement savings right now, you're simultaneously building the reserve that could fund your long-term care needs later. A larger retirement account means more resources available for penalty-free long-term care premium withdrawals, more self-funding capacity if insurance isn't available, and a larger safety net against the catastrophic costs we discussed. The Super Catch-Up isn't just about retirement income. It's about building the financial fortress that protects you against every risk we've discussed on this channel. Healthcare gaps, long-term care, inflation, Social Security uncertainty, all of it. The more you build in this 4-year window, the more options you have for every single challenge that retirement will throw at you. Let me now give you the complete action plan, the exact steps to take starting today. Step 1. Confirm you are between ages 60 and 63 right now and confirm you have access to a qualifying employer plan, 401k, 403b, governmental 457, or the thrift savings plan. Step 2. Log into your plan portal today and check your current contribution rate and dollar amount. Know exactly where you are starting from. Step 3. Calculate the maximum you can realistically contribute this year. Work backward from the $34,750 limit and figure out what monthly contribution level gets you as close as possible. Step 4. Update your contribution election to the new higher amount. If you don't know how, call HR today. Step 5. If you also have an IRA, maximize that contribution separately up to $8,000 for those 50 and older, using traditional or Roth depending on your tax situation. Step 6. Put a reminder on your calendar for your 64th birthday, because the moment you turn 64, the Super Catch-Up ends, and your limit drops back to $31,000. You want to know exactly when the window closes. Step 7. Revisit your contribution level every January, because the limits adjust annually for inflation, and you want to capture every dollar of allowed contribution each year you're in the window. Now let me recap everything we covered. Secure Act 2.0 created a Super Catch-Up contribution for people ages 60, 61, 62, and 63, the most generous retirement savings window in American history for this age group. For 2026, the Super Catch-Up limit is $11,250, making the total 401k contribution limit $34,750 for qualifying individuals. This is higher than the contribution limit for someone 64, 65, or any other age. The 4-year window is uniquely powerful and uniquely limited. Combined with an IRA, someone in this age range can save up to $42,750 in tax-advantaged retirement accounts in a single year. The tax savings from maximizing this contribution can be $2,500 to $4,000 per year or more, reducing your tax bill while building your retirement security simultaneously. If this video gave you information that could genuinely change your retirement outcome, hit subscribe because every week I break down retirement money topics just like this in plain simple English, and share this video immediately with anyone you know who is 60, 61, 62, or 63. They may be sitting on one of the most valuable windows of their financial life and not even know it. I'm Bob, this is Retired Not Broke, and I'll see you in the next one. And drop a comment below. Are you in the 60 to 63 window right now? Did you know about this provision before today? I read every single comment, and I want to know how many of you are going to take action on this today.